Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Zoom. So Zoom just reported the Q4 results last night. The stock immediately sold off, but then it kind of recouped a significant amount of ground as investors started to kind of disseminate what's actually at play here. And I think that's quite interesting because I think that could be some good news here. I think that puts Zoom amongst a very small select number of companies that, as the earnings have come out, has not meaningfully blown up. So I think that's quite interesting. I'm going to talk about Zoom's free cash flow. That requires a little bit of interpretation. But ultimately, the stock is priced at approximately 31 times its non-GAAP EPS. So that's for not for this year, but for next year. So we're looking 2 years out. So it's kind of, there's some puts and takes as we go through this. But the important thing to realize as we go through this video is that I'm talking about the fiscal year here, because the calendar year and the fiscal year are misaligned. Okay, I'm just going to be talking about the fiscal year. So they're guiding already for fiscal 23. So that's what I want to talk about, the fiscal year, and just to, when we go through, it makes more sense if you got that in mind. Okay, so in the past several months, Zoom has sold off. Everyone kind of already knows this, right? So what's important right now is I've got this hypothesis that the market is kind of slowing down the selling. There's been, it's been just one trade in the past several months. In the past several months, it's been irrespective of the gross margins, irrespective of the narrative, irrespective of the profitability profile, irrespective of anything. Doesn't matter, valuation, nothing. It's just been one trade. Everything has just been a boof selling off. But right now, I'm hopeful that what I see is that the market is starting to be a bit more discerning and picking and choosing. I'm inclined to believe that from what I see, the market is trying to say, okay, this business is profitable. Okay, that's fine. I'm going to side with that. This business is a growth story with colorful stories, and I'm not going to be too involved with that. That's what I feel that is happening right now. And many of the companies that have been reporting the last several days and even into last night's results seem to imply that. So I think that's a bit of good news that I wanted to highlight. So here's the thing, right? The guidance for Zoom is for approximately 12% for the year ahead, okay? And everyone's like, oh, lowballing. They're lowballing their estimates. Zoom is going to come out and demolish this. And I'm like, yeah, probably. But demolish by how much? That's the question, right? So as I look through here, so in the past, let's count it, how many is this? Several quarters, basically since the pandemic started, they've always beaten estimates, so these guys, like, terrific, right? But look at how much they've beaten by and how much it's decreased over time. So coming out of April 2020, it beat the top line by 60%, and going through to up until last night's results where they just beat by 2%. So there's a very consistent deceleration in the amount that they beat in the estimates. So is Zoom going to grow at 12 to 15%? I think that's probably, probably right. I think that, and the question really is not so much how much they're going to grow this year, but how much are they going to grow at next year? That's really the key to try to solve this one. So because there's going to be a lot of different moving parts this year, as there's some churn, etc. But so I think that's going to be, a critical understanding is how next year, fiscal 24, is going to play out. But I get ahead of myself, okay? So here's the thing, right? So Zoom is obviously, it was a COVID winner. Everyone knows that, okay? But it's the leader, if not, definitely one of the leaders, but if not the leader in telecommunications, okay? So, but they haven't rested on their laurels. They've just continued to add new products and services. So they've talked about events. Now you can chat, Zoom connected devices. That's a big one that people talk about a lot. And most recently, last week, contact center. So this is the ability to give their own customers an omni-channel engagement solution, optimized for video. I've got this hypothesis that Twilio is going to be much more overlapping with what Zoom does going forward. I think that people are not really talking about that a lot, but I think that there's this hypothesis that I've got that they're going to be much more, because that's what Twilio does. It offers you a way to engage with your customer, and I think that they're going to, Twilio is going to be trying to come over to the market, total addressable market of Zoom, and Zoom is going to try and go to total address, because they're both, they're both mature in businesses, and I know people don't like me saying that, but that's the truth, yeah, people don't like those kind of things, but anyway, so as enterprises continue to embrace this hybrid environment, some are just wanting to say, okay, no, enough of this hybrid environment. Others are kind of like, yeah, we do actually, this works for us. They want something that allows them to communicate and collaborate with other team players without having any technical issues. And on this front, Zoom excels. Now, the next part takes a bit of kind of understanding about this. I'm going to try and go through this slowly. I hope that this makes sense. So everyone talks about, oh, Zoom is a free cash flow machine. And I'm like, yeah, okay, yes and no, okay? So you can see here, so Zoom's free cash flow increased by approximately 12% year over year relative to the same period a year ago, okay? So we have 1.6 billion relative to 1.4 billion in the same period a year ago, okay? I get that, right? Now, the bulk of the deferred revenues is what's driving that free cash flow, okay? So I made a little green box. You can pause the video there if you need. So in last year's fiscal results, they had 670 million of deferred revenues, and this time around the deferred revenues have dropped to less than half of that. And deferred revenues is cash up front, okay? Zoom gets paid cash up front for services that they're going to deliver. So it's a subscription business, right? And that cash up front gets driven by two factors. Only two factors really drive that. So it's either more and more customers embracing the platform, or the existing customers embracing more and more products and services. Okay. Now, if we look through here, you can see here that in the red little box, it shows that the customers with more than 10 employees increasing year over year was only 9%. And this is the lowest figure in the past year. So it tells you that new customers coming and increasing and adopting Zoom as a platform is just falling off a cliff. Sorry, I mean, that's a bit bombastic language, but I mean, for all intents and purposes, it's really slowing down, okay? So we've gone from, it being the one platform that everyone's like, oh my God, this is the one I've got to use, to kind of like, I can use something else probably cheaper. And I know the Zoom bulls don't like me to say that, but look, 9% is not, it's not growing that fast, okay? So they talk about on their prepared remarks that starting Q1, the deferred revenues are going to be at the peak, and then it's going to moderate over the rest of the year, reflecting a smaller renewal base. So they're telling you right there and there, in black and white on there. You can look on their website, taking this quote from their website, and it's just not going to be, the deferred revenues are not going to be that strong, so that means the free cash flow is not going to be that strong, and that's going to have an impact. It won't have an impact today, and I think people are just kind of delighted that it hasn't exploded, but the analysts, the street and institutions going through this over the next coming days, they're going to start thinking themselves, and they're going to be scratching their head, because those are the ones that really move the needle in the share price. They're going to kind of sit down and think this through, and it's, the free cash flow profile is not going to be that strong. So wanted to highlight that for you. Now, here's some back of the envelope calculations, okay? So they guide for 3.51 non-GAAP EPS for this year, okay? Now, if we think about it, and let's say that over into fiscal 24, that they grow their EPS number by 20%. That's not that easy a hurdle, right? Because they already maximized the operating leverage that they've got. They already maximized the operating margins. They haven't got that much revenue growth to really expand further the operating margin. So for them to grow next year, fiscal 24, by the EPS numbers by 20%, it's going to be tough. But let's say they do, okay? If they grow then by 20% year over year relative to the guidance for this year, they're going to end up with $4.20 of non-GAAP EPS. And if you think about that, at $4.20 EPS, that puts the stock price at approximately 31 times non-GAAP EPS for not this year, next year. So it's not the cheapest stock out there, but if you want to pay for a leading business, I think that this is probably the best multiple you're going to get for a while for this type of investment, because ultimately it doesn't have a lot of capex. A lot of the free cash flow, a lot of the EPS numbers converts to free cash flow. So I think that altogether, I think that there's more here to be compelled about than there has been for a long time. But if you want to find out some of those group of stocks that I'm looking at right now, that I think that, hey, this is really, really compelling, don't forget to check out my marketplace. It says right there, deep value returns. Welcome to my marketplace, and drop me a line. Check out what other people said. Check out the reviews from my platform, and yeah, hope to see some. Thank you. Bye bye.